This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, MICHAEL COVEL. Not filtered, raw, honest. That's my passion. So today, as I sit in, I can't really call it sunny today in San Diego. It's kind of windswept and 50 or 60. I wish it was sunny. I mean, I'd be outside, getting a tan, which is, I guess, what I'm supposed to have being in Southern California today. But joining us from Australia is Nick Radge. And Nick is a money manager. He's a trader, longtime trader out of Australia. And we come from a related world in the sense that we both have a fondness and an appreciation for the trend following realm. And so, Nick, I wanted to welcome you today and appreciate you for coming in on the other side of the great blue ball of planet we call Earth.
Thanks, Michael. Thanks for having me today. I'm sorry to take up your time on a Sunday.
No. This is great. Well, look, it's a Monday there, Sunday here, right?
That's right.
Kind of how it works. You got to roll with the punches. But I want to be in your neck of the woods soon. I have an interest. I don't know where it's going to be. It's Singapore, Hong Kong, Saigon, somewhere in that neck of the woods. I'd like to be. But
well, it's funny you say that because they're still a good 8 hours flight away from us. So you're only halfway here when you get to those part of the neck of the woods. So look, we'd love to have you out here. I think everyone in Australia would love to have you out here. Certainly.
Yeah, I'm gonna have to make it down. I've not been down to Australia yet. So, yeah, I definitely have to do it. So how is the weather there today? I told you my San Diego setting. How is it there today?
Well, I live in a beachside resort town myself. It's a little smaller than San Diego. We've only got a population in the region here of about 44,000. So it's a pretty relaxed resort town. It's a nice day today. We're just coming out of the end of summer now, but we've had a pretty wet summer. But yeah, it's good. We have the tourist season come in and out, and it's getting back to the quiet time now, so I can get back on the river and do a bit of fishing quietly.
There you go. Well, before you and I talk about all these interesting things, I think we want to give the audience something to chew on and kind of really pick your brain today, because I know you've got some experience to pass along to people, and I think people will enjoy it. But I was texting you before on Skype, and I said one of the things that I wanted to really ask you about was your early life, and maybe if you could even go back and talk to me how you were thinking as 12, 13-year-old teenager, and maybe how some of those early aha moments, first experiences with trading, something that kind of, before we even get into this trend world that you exist in today, how did the start happen?
Well, the start happened. I was unwittingly introduced to trend following literally from the day one. Let's go right back. I finished high school. I had absolutely no idea. I was just an average grade student, nothing special. Finished high school, had no idea what I wanted to do. I do lie. Actually, what I wanted to do was work in the city, in a building, carry a briefcase, and catch the train. That was my goal when I left school. So I didn't go to a university. I don't have a degree. I have no further qualifications apart from a high school certificate. A girl I was seeing after I left high school, her brother-in-law worked for a big, well-established stockbroking firm, and he was looking for a clerk. So it ticked all my boxes. I got to catch a train to work, carry a briefcase, and wear a suit and work in a building. So I thought this was pretty good. And so I started this stockbroking firm as a clerk, but I was actually in the commodity section. They had a small dealing desk there that dealt in interest rate and bond futures here in Australia. But one day, I took a bit of a stroll around the office and I walked past the equity private client advisors. And there was one guy and he had some chart paper in front of him. And this is 1985, Mike, but really before too many computers and that kind of stuff. And he had some chart paper and he was doing a 5 and 10 day moving average crossover of the share price index futures, which is the same as your S&P 500 futures. And I stopped. It just made sense. I'm looking at this. I said, what are you doing? He goes, well, when the blue line crosses the red, you buy, and when it crosses down below the red, you sell. And I could see it. I could see the trends on the chart. It just clicked. It just made sense. Now, by 5 p.m. that day, I went down to the stationery store. I got some chart paper. I got a black pen to mark out the high-low close. I got a red pen. I got a green pen, and I started working out the moving averages. And then about 2 or 3 days later, when I was really seeing these trends come along and making sense to me, I decided I'd open a futures account. Now, I was 18 years of age. I was earning $12,000 a year. And I've gone into the office manager, who was a wily old man, had been around the block several times, and I said to him, I want to open a futures account. And this guy just literally looked at me.
Hold on, 18?
Yeah, 18.
Okay.
He's just looked at me and just shaking his head. He's just can't believe that an 18-year-old on 12 grand a year wants to trade futures. And that was the start. He said, okay, well, if you want to place an order, I'll let you do that, but I've got to sign the ticket each time you do it, and then you phone it down to the trading floor, and that's how I started. And that was in 1985. That went along okay for a little while. Then, back in those days, Mike, it was an old scrip stockbroking department, so it was actually, you had to send paper around the place. It wasn't electronic. And the script desk was handled by a friend of mine. And back in those days, before 1987, the stock market was moving along so quickly that people were buying stocks and then realizing that they actually couldn't pay for them. So in that situation, what would happen is the script desk would take ownership of that stock, and then they had 2 weeks to sell it. So you can imagine what would happen when those, halcyon days running into 1987, the stock market just was going up day after day after day. So if you could sit on this stock without paying for it for 2 weeks, well, you'd come home and make a mozza. So that's exactly what we started doing. Of course, one day it all went pretty bad. In September or October 1987, I think I was holding about $250,000 worth of stock that I hadn't paid a cent for. I was earning $12,000 a year. And so by the end of the day, I was my trading career had come to a very, very quick finish, I should say, and my father bailed me out. So that was a very expensive lesson, but I was only 18 or 19. And thankfully I was young enough to, brush myself off, get up and keep on going. And that's my one and only big lesson in life. And, I bought myself, this may sound a little bit odd, Mike, but I bought myself a diamond ring a couple of days after that event. And I still wear that ring today. It's a memento of don't be such an idiot. And I still wear that ring today, over 30 years later. Okay,
so let me dig back, because I know this was early in your career, and obviously we're going to get to a more evolved place where you are today. But I'm curious, back when that happened, because it kind of reminded me of a conversation I had with Salem Abraham, who was also trading at that point in time and was also of a young age, and saw firsthand how these markets expanded and went multiple standard deviations away from where they should have ever gone or that anyone ever expected. So what kind of strategy were you using, even though it sounds like you were highly levered coming into fall of 87? What were you doing exactly?
What I was doing is basically, well, you could put it down to an arbitrage, simply. I mean, what would happen is mums and dads would buy stocks, and then they would realize they actually didn't have the money to pay for them. So the stockbroking company actually took control of that stock, and then there was a 2-week window of settlement where they had to sell that stock back out again. Now, for some reason, in this script department, we were able to actually take ownership of that stock for that 2-week period of time without paying for it. And so it was like an arbitrage. It was like, oh, here's some stock that was bought yesterday for $10, and look, today it's trading 11. Wow, I've made $1. I haven't paid a cent. What's going to happen in 2 weeks? Because I'm allowed to hold it for another 2 weeks. And back then, 2 weeks, the market moved a long way up in 2 weeks. I had never seen the market go down in my whole career. Albeit my whole career at that stage was only 2 years in length, but at 18 you know it all, and it's all pretty easy, right? So I had was able to hold this stock without paying for it for 2 weeks. And, I just had to sell it and make a profit and walk away without paying a cent. But greed got the better of me. If you can do it with $5,000 of stock, well, you can do it with 50 grand of stock, and then all of a sudden that's pretty easy. You do it with 100 grand. It's like writing options, Mike. Options writing is good until it doesn't work, and then you're out of business, as you rightly said before. And that's exactly what happened.
But there'd be long-term capital management a decade later there.
Well, that's kind of exactly the same thing. It was a little too good to be true, and we were, I was young and stupid and arrogant, and as you are at 18 and 19, and nothing could go wrong, and
Well, was that the moment though? Like when the dust settled, did you walk away from it, or did you say, hey, now this big event has happened and it spurred you along? Or take me from there.
Well, I didn't actually realize how much damage I'd done to my own account for about 3 or 4 days. The first thing that happened when I walked into the office on that morning, I think it was a Tuesday morning here in Australia, and I've walked into the office, and we normally had one secretary out answering the phones, and there was about 4 women out the front answering the phones, and the phones were going mental. And I've walked inside the office, and there was lots of people running around, and lots of people that looked like they'd been there all night, and I knew something was going on, but I didn't get the full gist of it until I went down to the trading floor. That was my first time I was told to come down to the trading floor and help out. This is the Sydney Futures Exchange, and everybody, the bond and interest rate pits opened a little bit earlier than the stock indices opened, but everyone was sitting there waiting for the stock market to the stock indices to open, and it was just horrific. Normally there's a 1 tick bid offer spread. The traders had agreed that they would quote 50 tick bid offer spreads before the market opened, and it just went one way straight away. It was unbelievable. I vividly remember security guards came in within about 1 minute of the opening bell and physically removed some of the option traders. These guys had been selling options for the last 3 or 4 years. These are the kinds of guys who had their Ferraris and their Porsches parked straight out the front door in the no standing zone, and it had all come back to get them, and they were physically taken off the trading floor. They were bankrupt immediately. And I was standing there, an 18, 19-year-old looking at this thinking, wow, this is quite amazing. And that's when it really started to kick in that something historic was occurring. And just to see the market movements, the share price index futures, a big day would be, 40 points, and you're talking this thing was gapping 200, 300 points backwards and forwards, and it was just horrific. So I guess the question was, did it make a big change for me then? Well, it certainly made me go away and think about what I was doing. I certainly had no strategy. I certainly had no risk management or anything like that. And yeah, I probably went into the grey ether, if you like, for a few years until it started all coming back again. And, probably 4 years, I think I sat more or less on the sidelines, didn't do a great deal until I got inspired yet again. And funnily enough, that inspiration came from one of the turtles who I heard talk, and that's when I got back into it again.
Well, it's funny. I think a good jumping off point as we get into this trend conversation and a lot of the different areas that go along with it. I noticed, and I implore everybody to check out Nick's book, which is called Unholy Grails. It's a book that came out here this year. But in there, I noticed something near and dear to me, because it's not a quote that anyone can. If my memory holds right, I think it's not a quote you can go find in another book except mine, because I happened to be sitting in the room when the man said it, which was the quote from Campbell and Company about how they could do everything on the back of an envelope in terms of their trading. And just to put a little context around that, when a trend following system is got rules, you can write those rules out. And what this very prominent trader was saying was like, look, yes, what we do takes discipline. Yes, what we do takes smarts, and we got to stick with it and all that kind of fun stuff. But the landscape of it, the outline of it, you could sketch on the back of an envelope. And I noticed that you gave me some props, but you dropped that quote into your book, and I love that quote. I mean, I love that. And I think obviously maybe I'll let you run with that. I mean, just when you hear that quote, what does it mean to you?
Oh, it's absolutely right, Mike. And, I've got it from your book, and it has sat with me with so many other of the quotes from your books for years and years and years. And it's something that I tell all my subscribers about. Simple does work. It really does work. And people are easily put off. They think there must be some kind of complexity and profitability, and that's what they go looking for. And what I say to people is the more you look for the truth, i.e. specifically wanting to be right more often than wrong, because that's exactly what society demands of us, correct? That's how we're brought up. We're brought up to be right. We go to university. The people that get the better marks in university get the better jobs, get the better careers, the higher salary, the better lifestyle. So naturally, when it comes to trading, as you're well aware, people tend to go for a strategy that has a higher winning percentage, and they think there must be some kind of complex formula to do that. And that's just not the case at all. And simplicity works best because simplicity is robust and it works exceptionally well. I mean, in that book, Mike, towards the end, I fully disclose a strategy called the 20% flipper. Now, I'm not sure whether you took a look at that, but that 20% flipper strategy is remarkably simple, and I'm happy to talk about it here. Basically, if you buy, and it's a long-only stock market strategy, trend-following strategy, but if you buy a stock that moves 20% from a low point, so you're buying with the momentum, you're buying with the trend, and you exit that position when it falls 20% from any specific high point, then on a portfolio of 20 individual stocks, you've got an annualized return over the last 15, 16 years of in excess of 20%. And that's a very, very simple yet robust type of strategy that works particularly well here in Australia. It works particularly well in the US, and it doesn't matter what universe you work it on. And the simple premise is if a stock is going to double in price, that is, if it's going to go up 100%, well, it has to go up 20% first. And it's simple, it's robust, and one of the things I try to get through to my clients is you need to intimately understand why your strategy will work. And all you have to do is bring up a stock, and I guess, we only have to look at some of the big name stocks in America. You can see these spectacular trends, and for those trends to occur in the hundreds of percent, well, they must rise 20% to start with. And that's what it's all about. You're
being very mechanical about this, though. I think if people are listening, they should be. You're not ascribing any emotion to it. You don't really care what stock it is. You're saying, where's my 20% I can grab here?
Yeah. Look, I'm not a stock picker, Mike. I'm the world's worst stock picker, and I happily admit that on national TV here in Australia. People they just shake their heads. They go, you can't say that on national TV. But I am a bad stock picker. To give you an idea, over the last 6 or 7 years, my major trend following strategy here in Australia that trades long only equities, my win rate is 50%. It's basically, I think, about 49.6%. Now, to give you an idea, in that period of time over the last 6 years, my compounded annualized return is about 18% compared to the market 2.7%. Now, that's only getting it right 50% of the time. And the thing I like to tell people is I don't pick stocks, they pick me, because they float to the top. I don't have to pick the next best sector. I don't have to time when the market's going to be good, when it's going to be bad. I just have to be there for it when the time comes along. And I think that's a very, very good lesson, especially when you're trading equities, especially on the long side. You can't afford not to be involved during those good times. They are the bread and butter times. To give you an idea, the 10-year annualized return here in a 10-year annualized return here in Australia, for example, is about 8.5%. Now, if you had stepped aside in that 9-month period following March 2009, so the markets hit the bottom in March 2009, if you had said it's all too hard in early 2009 and stepped aside for 9 months, your annualized return goes from 8.5% down to less than 1%, just because you missed that 9-month period of time where the market jumped, 30, 35%. And that's what everybody does. They get scared at the bottom. They don't want to participate. And a lot of people did not participate in that period of time in 2009. And even now, you look at the markets in America, your markets are really zipping along over there at the moment. The NASDAQ's at 11, 12-year highs. The Russell, the S&P, they're within, 5-8% from their all-time highs, and people are still talking doom and gloom. I just find it absolutely phenomenal. If things are that bad, why aren't we back down at the lows in March 2009? And people are still scared to participate in the market, and that is because they have got no way to get out when things turn sour again.
Yeah. Well, I think in America, I think the doom and gloom for a lot of people is going to continue to be there. But I tell people, it's like, look, if you want to have a political or an economic view, if you don't like the way the Fed is run, fine, have those views. You might very well be right. Zero interest rate policy, we could just look back 15 years from now and go, pretty obvious why that all happened. However, have a trading system, and if the market's going up, if the equities are going up, be long. Like, don't let your negative view, even if it might end up being right at some point in the future, don't let your negative view today in the current affect your trading decision.
Yeah, absolutely right. And it's a very, very costly mistake. I used to have a client who was a subscriber, and he subscribed to one of these big US newsletters. I won't mention the name, but let's say that they're quite outspoken. They've been bearish to the point of writing books about it over the last 10 years, and they remain bearish to this day. So in 2000, I think it was 2001 or 2002, this particular gentleman, he had about 800,000 in his superannuation or his 401k. He would only ever invest 5,000 in the stock market. He sat in cash, and he continues to sit in cash today. Now, between 2002 and 2007, we've had one of the biggest bull markets in history, and he sat in cash the whole time because he was absolutely convinced the market was going to tank. Now, here's the thing. This gentleman, at the time, was in his early 60s. And that is the time where you've got to be putting your money to work. You can't be sitting in cash at that age. If you're in your 80s, maybe sitting in cash, but not in the early 60s. So the damage he has done to his retirement fund was absolutely horrific, simply because he listened to this doom and gloom advice that was, that was going around back then. It still goes around today.
Yeah, it's I got to jump back though. You mentioned one thing about the stock picks in Australia. I was dealing with a PR professional recently, and she's like, okay, I'll put you on all the shows and da 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 da. And I had not had any involvement with her, but she was very well respected. And so then I got to the end of the conversation. I said, but you do understand, I will not be giving any stock picks in any way, shape, or form for. And there was like this long pause. What are you talking about? You have to give stock picks. I can't put you on air unless you give stock picks. And it was it was like this. I thought I was on the same page with this woman, and then in one snap of the fingers, it was. Well, I guess we're not going to be working together. So.
Yeah. Well, I appear on a very highly rated show out here. I really don't appear a great deal. I think 3 or 4 times a year. I'm not sure whether that's because of my opinion, which is very much aligned with you. They asked me, what are your 10 best picks for the next 6 months? I go, well, I don't know. What's your favourite sector? Well, I don't know at the moment. I've got these stocks on, but they may not be there in 3 weeks' time. And it's a call-in show. People actually ring in and say, what do you think of this stock? What do you think of that stock? And my answers are very generic, very vanilla. Well, it's going down. Why the heck would you want to own that stock for? You can't make money when that stock's going down.
So they don't keep putting you on with those kinds of answers, though.
Well, there's plenty of other guys that seem to get a lot more airtime, and they have an opinion, and it all sounds pretty good, but it's a bit of a standing joke.
I want to circle back to something we talked about a few minutes ago, because I've seen it happen in my world recently, which is there seems to be this fascination. The jargon of the day is algorithms, formulas,
yeah.
and I'm seeing people. Just in my opinion, bastardize the phrase trend following, which I think really trend following is not the greatest description, because it's really about having a system, a trading system. These happen to be trend following trading systems. But I'm seeing people in various online incarnations talk about trying to find trend following algorithms, trend following formulas. And they say it in these kind of very big picture ways, like there's secret, super uber sophisticated formula that you must locate. And I'm the whole time, and if you ask them a specific question, they just give you back some squishy something that doesn't answer it. But the whole time I'm thinking, what would you do with this formula? What is this formula going to do for you? I mean, because from a trend following perspective, you got to have a portfolio, you got to have money management. We're going to talk about that. You got to have an exit strategy. And maybe the least important thing is your entry strategy. So when you hear that, algos and formulas, what goes on in your head?
Yeah, well, I mean, you're quite right, Mike. There's a lot of people, and it may well be to do with the communication or the ease of communication across the world these days. But, people come to me and say, all these computers, these algo traders. What people don't understand is these algo traders have been around since the 60s, especially the high frequency type style trading. They've been around since the 60s. A lot of the trend following, people around that use computers, they've been around, forever. I remember being on the trading floor of the Sydney Futures Exchange back, I think, 89, 90, when they first started hitting the market there, and they would come in with huge volume. And it was really interesting for me. It was like, right, why is this person coming in and buying 5,000 futures contracts right here? What's caused them to do that? And it's always been there, that's always been there. It's just a trendy thing to talk about at the moment, and people are scared of it. It's just been recently introduced to Australia on the stock exchange. I think Goldman Sachs has just opened up a high frequency trading desk here in Australia as well. But from a trend following perspective, it's not going to make any difference in any way, shape, or form. What's
the relevance? I keep asking myself, what's the relevance?
If you're a scalper and you rely on the depth of the market, then you're going to have a few problems. There's going to be a lot more noise there than maybe what there was 4 or 5 years ago. But trends can't not exist. They have to always exist. And they have to always exist because the economy is always shifting back or forth, and human sentiment, which is ultimately the driver of the market, is always shifting backwards and forwards, and therefore trends will always occur. And, I think people, again, are perhaps finding excuses for their poor performance. I think that's appropriate to say that. I know a lot of people come to me and say, we can't really participate in this market because of these high frequency traders now, then we don't have an edge, we can't participate against that. And I've seen that on a number of forums, and that's just totally incorrect. They've always been here. Okay, maybe they're a little bit bigger today.
Arbitrage is not a new concept.
No, that's right. But a lot of people think they are, simply because it's now in the media a lot more, but they can't disrupt trends. Yeah. And, I had a big run-in with a very, very major Australian educator whom in 2009 came out and basically said in public and in newspapers, wherever it can be heard, that whatever strategy you've used for the last 20 years will not work ever again. And I took that to heart. I just thought that was an absolute lie. And here he is out there putting that out there. And of course, he had the answer, right? He had the new answer, that the new paradigm that you had to use now that hasn't worked for the last 20 years. So his point of saying that was merely to scare people and to sell something different. And maybe his strategy didn't work anymore, and maybe it wasn't robust enough to facilitate what's going on now. But you can't tell me that markets are going to stop trending. I mean, they just can't stop trending. It's just a ridiculous thing to say that what's worked for the last 20 years ain't going to work again.
Well, and we also, as you say that, I think even the baseline explanation, I guess we can get a lot deeper on that, but is it, markets are just human beings. They're just comprised of human beings. It's human behavior. I mean, different human beings are going to have different perspectives on what a valuation might be, and they're going to bet differently, and they're never going to be 100% aligned. And if they can't be 100% aligned, there's going to be extremes that things are going to get pulled to, and trends will end up happening out of these extremes. It's as you say, it's basic.
Oh, absolutely. And I think you've only got to look at what's happening right now, and people still can't acknowledge that these US stock markets are within grasp of all-time highs. You know, they're really struggling like that. They're shaking their heads. How can that be possible? It doesn't matter what or why. The fact is that it is occurring, and they've been trending beautifully. So there's no point trying to find out why or reason why against or whatever. It just is. It's happening. You're either on it or you're not. And if you're not, well, that's your own bad luck kind of thing.
Well, that might lead into something. You got a nice phrase here that I like, becoming a hitchhiker. And maybe you might run with that. I like that.
Yeah, look, it's an analogy I've been using for a number of years now, and people certainly relate to it. We can talk in as many financial metrics as you like, but at the end of the day, people relate to very simple concepts that they can see in the real world. Now, a hitchhiker is pretty straightforward. Let's use the US because everyone can relate to that. So let's assume that we want to hitchhike from San Diego to LA. Well, the first thing we know is we're not going to stand on the southbound lane of the freeway, are we? We're going to stand on the northbound lane of the freeway. The next thing is we stick our finger out. We don't know which car is going to stop. Now, the analogy is obviously we don't know what stock or what commodity is going to trend. We just don't know. But if we put our finger out and we're patient enough, we know a car will stop and will pick us up. The next thing to understand is that we do not know how far that lift will take us. I don't know too many of the towns just north of San Diego. I mean, what have you got up that way? You've got
Carlsbad, and you got Laguna Beach, Newport Beach as you're headed towards LA, Irvine.
Yeah, so exactly right. You don't know how far your ride is going to take you, but you
hope it goes all the way to LA. You hope.
You hope
you don't know.
That's right. Hey, here's a story. I backpacked around the US back in the early 90s, and I was in New Orleans, and I had $10 in my pocket. That's all I had left, and we wanted to go to Florida.
No joke. Hold on. $10. Seriously, true.
True.
Nothing. So you're basically broke. You're on the streets of the US broke.
Yeah.
Okay.
I had $10 in my pocket, and we had to get to Florida. Now, I actually got in a cab because it was absolutely pouring with rain, and I said to the cab driver, I've got $10. Can you take me out to the freeway and put me under a bridge? And he did that. So there I am on this, 6-lane motorway heading towards Florida, and I put my finger out, and within 2 minutes, a car stopped. Now, that ride took me all the way around to Orlando Beach in Florida. One ride from New Orleans. It took about 3 or 4 days or something like that, but the one ride took me the whole way, and finished off being in spring break. So you just never know where that ride's going to take you, and you don't know which one it's going to be.
So I got to tell you though, so come in the exact opposite direction, because you would have been on Route 10, I believe, going across the Panhandle from Louisiana. Well, coming the other way from Jacksonville, headed towards Louisiana, there's a national forest. And I was going to school in the Panhandle of Florida off that 10, which you would have passed on your hitchhiking route. And I'm going through this national forest, and there's no pull-offs. There's no stops. You're basically 20, 30 miles away from anything. And I see a hitchhiker. But I have to tell you, I did not stop to pick her up. And I have to tell you why. Because she was, and I'm not picking on anybody that might have a weight problem, but she was 100%, 300 pounds plus, and she wasn't wearing a stitch of clothing. And that was the hitchhiker that I did not pick up. So, you're lucky that you made it, but I don't know what happened to her. But so anyways, same road, basically. So.
Yeah, but using these simple analogies, people can relate to them. Another one I like to use is teaching somebody how to trade. Okay. There's specific rules, and I call them quantitative rules, that you can teach people. And then there's other rules, or there's other parts of trading that are a little bit more difficult to teach people. In fact, I believe you really can't teach them, and I call them qualitative rules. Now, if we use the analogy, and I've got a teenage daughter who just recently I was teaching her how to drive. I used to have hair before I was teaching her how to drive. Now I have none, but you teach a teenager how to drive. The quantitative rules are pretty straightforward, okay? Put your foot on the accelerator to move the car forward. Turn the wheel to the left to go left. Turn the wheel to the right to go right. put your foot on the brake to stop. Okay, they're repeatable and understood rules that can be repeated by a teenager and anyone for that matter. Okay, now in trading we have the same kind of things, okay? You have an entry mechanism, you have a stop loss, fixed fractional position sizing, an exit mechanism, so on and so forth. They are rules that can be taught and repeated into the future. And then there's a set of qualitative traits. And again, if we use the analogy with driving or teaching your teenage daughter how to drive a car, how do you teach a teenager to understand a dangerous situation on the road? How do you teach a teenager to understand that, driving in the wet creates more complications, it takes longer to slow, so on and so forth? These are the kind of things that you can't teach. They have to be learnt from experience. And in trading, that's the same kind of thing. I can tell people that, hey, our portfolio at some stage will have a drawdown of between 15 and 20%. It's going to happen. Yeah, whatever. But as soon as that happens, they run for cover. They run for the hills. And you have to experience that drawdown and come out of that drawdown. And once you've done that, the light comes on and away you go. But if you don't ever allow yourself to experience that because you run in the opposite direction because you're scared, then you're never going to get there. But I can't teach people that. I can tell people you're going to have 10 losing trades in a row, or you're going to suffer a 15% drawdown. And one thing that I stress to people is usually the pain they think they can handle, they've got to double it. I think that if someone says they can handle a 20% drawdown, chances are they can probably only handle a 10% drawdown. And that's the way I teach people, that really there's certain things I can tell you about, but until you experience it for yourself, I can't help you through that.
As you bring this up, the teaching aspect, I can't help but think, because you mentioned it earlier also with the phrase turtle, and I think about my second book, and I think about some of the research that I did in the interviews and finding out how that really worked. And literally, some of these people that were hired by Dennis, once they were given their rules, they're given their system, they were, unlike most of us where we have essentially free will to make decisions, they were almost petrified to not follow what he told them to do. Like, that was the deal. The deal was, you do what I tell you to do. So they literally were in kind of some of this, I don't know how to describe it, but I think most people can't necessarily appreciate how terribly odd, difficult, I'm not sure the exact phrase, it would have been to be somebody in that position faced with working for one of the great traders, and you just have to follow exactly what he's saying. And now you're going to experience those drawdowns without any context or gently coming into them all. It's going to hit you like a ton of bricks.
Yeah, well, I think the big difference between, what I see and what occurred back with the turtles there is, first of all, that wasn't their money, but it was still very, very important to them because they knew they had this lifetime opportunity that they were being handed on a silver platter, and so they didn't want to let that opportunity go. But, that's where they experienced their pain, I believe. But, the people I see, it's their own money. That's the pain, the pain of explaining to their spouse that, gosh, I'm following this guy, Nick Radge, and I'm losing 12% of my capital, and, I've got my wife or my husband on my back, and it becomes a different kind of pressure. But again,
well, how do you get people over the idea of lumpy returns?
Well, I never promote the possibility of lumpy returns. I mean, specific upside returns. I just don't go there.
No, I meant in general. That's what volatility. As a trend following trader, that's ultimately what you're left with at the end of the day. When time goes by, you're left with lumpy returns. Hopefully on the positive side. But it's never a kind of a people have. I always say to people, and I've said this many times in my podcast. If you see somebody who's producing 1% every month and never has a down month, you might start to get a little alarmed.
Yeah, sure. Well, absolutely. The one thing I do, Mike, is a lot of time window analysis where I go back and find out exactly how many months or how many years it would take to get to a 100% probability of profit. So my major trend following strategy out here in Australia, I can tell you that the probability of achieving a 100% profit, or probability of 100% profit, is at 22 months. In other words, if you can't give me 22 months, I can't guarantee you a 100% probability of profit. So we get people come to us, oh, look, we'll give it a go for 2 months.
Repeat that for a second, though. I think that was the way you phrased that. People need to be really kind of digest that again. Say that again how you just said it.
Okay, so we do what's called time window analysis. Okay, we want to figure out at what point in time we will get a 100% probability of profit. Okay, doesn't matter when you start. So we remove what's called start date dependency.
You're talking about probability of profit. I think I want people to really be clear about what you're saying. Probability of profit. You're not guaranteeing a profit. You're saying probability of profit.
Correct. 100% probability of making a profit. That profit might be 1%, it might be 100%. That's not the point. It's the probability of making a profit. And we want to find out at what point we hit the 100% mark. Now, with my longer term trend following strategy here in Australia, that comes in at 22 months. So at 6 months, I can tell you we've got a 60% probability of profit. At 12 months, I think it goes up to about 83%. But at 22 months, it hits 100% probability of profit, which means it doesn't matter when you start. It doesn't matter whether you start on January the 1st, December the 13th. It doesn't matter when you start. What matters is you give it 22 months. If you can't give it 22 months, then you have a risk, however large, of actually coming out behind.
How many people, Nick, in the middle of you either trading for them or they're a client of yours, you tell them this, they know it from the beginning, but they get into the middle of it and they break it. They can't handle it.
I'm not sure of the exact percentage. I can divide that party into two. We tend to have people that will come to us and say, look, this is what's going on. I'm not really comfortable about it. Help me out here. And then I can talk them through, show them the maths behind it and show them what's going on, and they tend to stay with it. Then you've got another set of people whom aren't willing to come forward and say, I'm uncomfortable. I don't know what's actually going on here. They'd rather go, nah, he's no good. He doesn't know what he's talking about, and go off onto the beginner's cycle and try and find someone else who, offers them a bit more of the Holy Grail, And we don't want those kind of people, Mike. We find we want to attract like-minded people. We want to attract people that help us out because they understand what we're trying to do, and it helps them out in the bigger picture. I think if people are in a hurry, you're not for us. It's just go and give your money to charity, or go and find some spruiker. But ultimately, you're going to fall into the beginner's cycle, and it's going to cost you a lot more money in the longer run.
I had somebody recently. They texted me and they had invested with one of the traders mentioned in one of my books, and they were writing me. This gentleman said he had read several of my books. He's writing me and he's saying, well, I'm very unhappy. I haven't made money for almost 2 years, and I was like, well, it's a trend following trader, right? And he's like, yeah. But the fixation on not having made the big money. Even though he had declared himself to be understanding of the trend following way, and even though he had made this allocation with a trend following trader, it all just went by the wayside once he got into the game. Then it was like all the other stimuli that was hitting him, perhaps a U.S. stock market going straight up, and he's in a diversified CTA, so there's not the same thing going on.
Sure.
Boom, couldn't handle it.
Yeah, we had that problem back in the late 90s when I ran my CTA. We were a diversified commodity trend follower, and we had the problem back then is the Nasdaq was going absolutely ballistic, and we had investors from Asia ringing up saying, why would we invest with you making 16% return when we can put our money into Yahoo or whoever it was at the time that's making doubling in price every 3 weeks. And they just didn't get the concept. But, call me cynical these days, but if people aren't willing to take the time to learn the ins and outs of the strategy, then, it's difficult for me to give them the time to help them out when the times get tough, We really focus on what can go wrong rather than what can go right. That's a big lesson that I learned from running the CTA back in the late 90s. We came out in our first year in 98, I think we launched, and we had a ripper year. I think we're up 20% in the first year. and most of the big managers were only up 2 or 3%. We had Goldman Sachs New York knocking on the door. We had everyone knocking on the door going, what are you guys doing differently? The mistake we made, Mike, is that we did not explain to our clients what could go wrong. And it wasn't so much what could go wrong in terms of a drawdown. What we experienced was a flat period for 6 or 8 months. And we had a lot of people on the phone going, what are you blokes doing? You're not doing anything. Why should I have my money with you? And our instant success we took on board and took new clients on board and did not explain to them what could go wrong. So that's been a number one foundation for us going forward ever since. We really tell people you have to expect this to go wrong at some stage. It may not happen for 2 months, it may not happen for 2 years, but it will happen one day, and you've got to be there and willing to push through it.
And
so that was
the great thing with good trend following approaches too is, sometimes things for trend followers go wrong, so to speak, which is an expected state of being. But when the rest of the world goes wrong, sometimes that's a great time to be a trend following trader, because that's when trend following goes really right. So it's people. I think it's being, you have to be philosophical about this to begin with. You got to say, well, what am I getting out of this? I mean, you've got this. It's one line I caught in one of your interviews. You talked about, look, the markets are always going to be there. It's not a race. The market's going to be there. Get your education first and be comfortable with what you're doing. Then you can start playing the game, but not until. What's the race?
Oh, absolutely. I mean, I've been doing this for 26 years now. The market's exactly what it was back then. And, I guess as you get older, you get the regrets. Gosh, why didn't I do this when I was 21? Why was I mucking around doing all that other garbage? But the markets will always be there. I had a guy I was talking at a trading investing expo in Perth the other day. And this guy came up after my talk and he said, I'm probably the youngest guy that's been in the talk there today. And I'm thinking, you've got your heads. This guy, I don't know what he was, 17 or 18, but he knew he was in a good spot. He knew he was learning something that he could apply for the rest of his life. And I said, gee, I'm 44 now. If I could be 17 again and know what I know now and what you now know, I think you're in a great spot. And I just said to him, I said, mate, you are just in a cracker of a position. You just got to put this to work and just let it go. Okay. Let it do its thing over the years and go and get a job, have a career, do this on the side. Don't focus on wanting to be a professional trader. There's probably nothing more boring in your life, but go and do what you want to do, get a degree, get a career, but just do this on the side and, give it 10, 15 years and, you won't have to work again.
Yeah. Let me, I kept you on the line here for a while, and I want to end with something that I think is, and I'll let you run with it, which is probably the most important part, one of the most important parts to being a trend following trader. And I know you've mentioned it quite a bit, which is your trade, your risk management. And I wonder if you could just, to some degree, I think, you and I hear these terms and we use them, but it's still, for a lot of people, it becomes jargon. It's like risk management. Well, everyone, Goldman Sachs is talking about risk management. Schwab is talking about risk management. Nick and Mike are talking about risk management. Not all risk managements are created equal, clearly. So maybe if you've got a way to kind of just take that concept of risk management, money management, trade management, and bring it down to a level where the average person that's not familiar with CTAs and not familiar with trend following can get an idea of what we're talking about when those terms come up.
Sure. Well, I think a good story here, Mike. Back in 2007, we run a turtle type strategy here in Australia on the equities market. It's a long only, but it's a breakout strategy. And we went into drawdown, as you do. And I think at the time the drawdown was at 11%. And I got a phone call one day and this guy said, I can't take the pain anymore. And it's like, what do you mean? What? I said, what do you mean you can't take the pain? He goes, I've lost 11%. It's too painful. And that got me thinking. That guy should not have been in that position where it was too painful to trade. Even if his risk tolerance was 11%, he should not have hit his risk tolerance cutoff in the first place. And I said to this guy, I said, how much risk per trade are you taking? And he said, well, I'm doing what is usual, 2%. I said, well, obviously 2% is not for you. Now, I went out and I did some seminars, and I rarely do. That's the last time I've done seminars. I rarely do seminars because it was quite clear that my message had not got across to people. So I went around Australia and I did a seminar for people, showing them how to manage their risk appropriately. And what I suggested to people is that the 2% rule is probably not appropriate for everybody. You know, the 2% rule, you risk no more than 2% of your capital in each trade. And everyone takes that as granted, and that's what they use. But if you have a strategy that has a win rate of 50%, then mathematics says that at some stage you will have 16 losers in a row. And if you're risking 2% per trade and you're going to have 16 losers in a row, well, your drawdown is going to be somewhere around the 30% at some stage. Now, this guy's maximum drawdown that he could take was only 10 or 11%, which means he should not have been using the 2%. He should have only been using about half, or even 0.4% per trade. So risk is a function of how much pain you can withstand in order to keep trading that strategy over the longer term. It is important that you trade the strategy over the longer term and deal with the bumps along the way. If you can't deal with the bumps, if you can't deal with the journey, then you're never going to make the destination. And it's another analogy, I like to use. Let's again get on the road. Let's say we're going to go from New Orleans to Florida. We know that you're going to have to stop to go to the bathroom. We know that you're going to have to stop and have a bit of a rest. We know you're going to have to stop at some stage to get some food. You might have to take a detour. The thing is, when we get in a car and we're faced with a journey like that, we intimately understand what the journey ahead is going to be like. We all did it as kids. But when it comes to trading, nobody tells us what the journey is going to be like. No one tells us that there's going to be losing trades in a row, 10, 15 losing trades in a row. Nobody tells us I'm actually going to have to lose 15% of my capital. The journey is not plotted out for us. And when it is plotted out for us, which is what I do for people, some people then aren't happy with that. They're going to diss you off and say, well, that's not acceptable, and that's fine. But I think a lot of people come into this game, they don't actually know what lies ahead, and as soon as they hit that first speed bump, then they get scared and they start looking for answers. They tend to throw the strategy away, and then go look for a better strategy. But obviously when they get to that secondary strategy, the same thing is going to happen, and the same thing and the same thing. So it's important for people to understand risk is part of the journey. There is nothing wrong with risk. I think Liz Chevelle summed it up beautifully in her statement. I think she wrote a paper on it, that volatility of your account is not about risk. It's just about traveling the journey, and you've got to be able to do that. You've got to be able to ride that. Obviously, there's different degrees of volatility. I think the average person, in my view, could probably take a 20% drawdown in their stride. Once you go beyond 20%, it becomes a little bit more difficult. But then you've got someone like Bill Dunn, who's just been, through a 60% drawdown. So the degrees of the journey...
And I must interject, though, at that moment in time, too, because at least, twice in the last decade, if you were just a typical buy and hold mutual fund investor here in the United States of America, you've experienced that 50% drop in the S&P. So I sometimes, and I know, trend followers are forced to wear their drawdowns like scarlet letters across their chest. But I think the old equity buy and holder guys, they now have them as well, and they now have the experience. And you asked that question early on. You say, well, what causes some people to be a little leery? And I think it's just that very issue. It's that it's experiencing those steep drawdowns as a buy and hold investor, which buy and hold is a system too. It's maybe not be the best system, but it's a system. And I think when people experience those massive drawdowns, they say to themselves, well, hold on. When I bought my mutual fund from Fidelity, they didn't tell me this could happen.
No, that's right. And, in some of my presentations I do at the expos, I actually put up 10 or 15 equity managers, and I've put some up, I've used Bill Miller in the US as an example. He just had a 65% drawdown. That was enough to basically get him to retire. But the question I pose to people when it comes to equity investing, you only get shown your return. These fund managers who have a 10% annualized return for the last 15 years, that's all good and well. But when you put your maximum drawdown and ask the question, are you willing to lose 50% to earn 10%, all of a sudden the equation's very, very different.
Yeah. I think makes trend following a lot more pleasant to look at.
Oh, absolutely. And, I say to people, look, with my strategy, at some stage, you're going to have a 20% drawdown. Oh, that's not acceptable. But hold on, you've been a buy and hold investor and you've just suffered a 50% drawdown. How does that relate? I mean, hello, you're not willing to, you've just lived through 50, you're still 37% underwater, but you're not willing to accept that 20% is doable.
It's almost like it didn't happen, though. It's all for buy and hold investors. It's almost like that drawdown doesn't really count. Let's just talk about the trend following drawdowns. Those are important.
And you know why, Mike? You know why that is? The reason that is because when a person gives money to a fund manager, it's not their personal doing. It's not their personal responsibility. It has nothing to do with them. It's like disconnection. But when someone does it for themselves, they take personal responsibility for it. And I think it becomes a lot more personal for them. So I have people who come to me, do their own trading following my instructions and have a 20% drawdown and are not happy. Yet by the same token, they can put their money into a mutual fund and be down 50% and live through it. It's not them doing it. That's the big difference, I feel.
It's interesting. It really is, because it's almost like I've noticed in the last year. I'm starting to see the typical when I'm out and about talking about trend following. I'm starting to see the typical. Well, I can't stomach those drawdowns, and then I'm like, well, but hold on. What happened to the S&P for the last 10 years? Did you forget about those? And I guess it's like been wiped. The slate's been wiped clean.
Yeah, I think a lot of people fail to take responsibility. If I use that analogy, are you prepared to lose 50% of your capital to make 10% return? I guarantee if we ask 200 people that question, you're going to get 200 people say, absolutely not, that's not acceptable. Yet out of those 200 people, how many of them would actually take responsibility, take action to do something better for themselves? I would say not many. You get a few perhaps, but the majority will stick with what they're doing in the hope that it'll come back. And that's what's going on with me now. I've got a lot of people who want to put their money into my managed accounts, but they're so far underwater with their other managed accounts or their mutual funds that they go, I'll just wait for this to come good. And I said, well, it's been 5 years since it was good. How long do you want to wait?
I want to add something too. So as people are listening to this, that I don't think either of us sound negative, but I could see some people saying, well, these guys are talking about negative issues and potentially losing money. No, we're not being negative. That's an emotion that somebody is ascribing if they listen to us. Well, I think what we're both trying to do is we're trying to be objective skeptics. We're trying to say, hey, what's the playing field that we're looking at? What can happen in the markets? What can we possibly do to make some money? And what are the pitfalls that we have to be aware of, whether they're the market pitfalls or our own emotional, personal pitfalls? And it just becomes a big discussion. We're having a discussion about how to approach all these things. But I think sometimes people hear these conversations and they might be saying, well, that sounded very negative and it's too emotional for me. No, that's not what we're trying to do. We're just trying to get you to be, awake to all of this.
Yeah, I think if people understand what the journey entails, if they really and truly understand, and here's a great thing I do for my subscribers, I put it on my Facebook page all the time to remind people, I go back and I get the track records of all those CTAs, all of them, Salem Abraham and Dunn and Campbell and all these guys that have been in the markets for 20, 30 years. And I get out their track records. In fact, one I use all the time is Liz Chevelle. I mean, she's got an annualized return of 22% or something over the last 25 years. And I say to people, tell me what you think a 22% annualized return for 30 years looks like. And they visualize that, right? They've got this perfect 45-degree linear equity curve. That's what they're visualizing.
They forget the exponential.
That's right. And I say to people, who wants a 22% annualized return? And everyone puts their hand up. Everybody wants it. And I said, okay, visualize what that would look like. And they're visualizing the 45-degree angle equity curve. And then I show them the month-by-month track record of someone like Liz Chevelle. And they can't believe that, geez, she's had losing years. She's had 5 losing years. That's ridiculous. That can't be right. And that's what I say to people. Liz Chevelle stands up to the plate every day, places orders, manages orders every day, every week, every month, every year for 25 years. She stands up to the plate because she knows she's got an edge. She understands that over time she can't lose. That edge is there. She can't lose. All she has to do is keep placing those orders and ride the journey. That's all she's got to do. So when people understand that someone like Liz Chevelle, who's been doing this for 25 years and has a 22% annualized return for that period of time, actually has a losing year, let alone 3 losing months, then maybe that is a little bit normal.
Yeah, I think those, you make a really good point about the performance reports, and that's why I put them all in my books. I think when people, when you literally, and I remember in early to mid 90s for the first time this happening, and seeing, when you sit there and you just look at these monthly numbers and you could learn more. I always say to people during presentations, you could probably learn more by taking that great Bill Dunn performance chart where he lists his ups and his downs, or even just a table of his monthly performance since like 74, and looking at it each percent either up or down for each month. You could probably invent an entire semester around that track record that would be far more interesting than almost any finance or economics class that you could possibly take at any university around the world. I really do. I think that would be just terribly interesting. I wake up each day because I think to myself, if that great idea has still not been done yet, then maybe we're you and I exist in a world that is at least stimulating.
I think it's important, Mike, you make a very valid point, but are people willing to read between the lines like you and I have done? That's the thing, right? You can show them that report and they just glaze their eyes over and think, oh yeah, whatever, that's pretty good, but they don't get it, they don't get what's going on there. A really good tool I have, and I'll send you this tool, Mike, you can use it for your clients. It's a random equity curve generator. And what I do is I put in the statistics, let's say a standard trend following strategy, for example. Let's say we put in a win percentage of 50% and let's put in a win-loss ratio of, let's say, 3-1, okay? Pretty stock standard kind of stats for a trend following strategy. And then what happens is this random equity curve has 2 equity curves. One of the equity curves consists of 1,500 trades. Now, if you can visualize what those stats would generate, I tell you it generates a pretty good 45-degree line over 1,500 trades. Looks great. So I say to people, who here would like to trade this equity curve? And I keep pushing the button and it keeps generating a random equity curve and they all look very, very similar. And everyone's got their hands up in the air. Yep, let's trade that one. That's great. And then what I say is I flick across to the 20-trade random equity curve generator. And I say to people, I want you to tell me which one of these you don't want to trade. Now, obviously, the snapshot 20-trade random equity curve is a subset of the bigger one. And all of a sudden, people can see the lumpiness, the ups and the downs, if you like. And it's a real visual representation where people are willing to trade one, but they don't want the other, yet the other is a subset of the first one. You can't have one without the other. But no one's willing to travel that immediate journey. So it's a really, really good visual tool.
Yeah,
and people
definitely,
get it.
Definitely. We'll make sure here at the end here in a few minutes, I'll make sure I get all your contact stuff, and so people can reach out to you as well too.
Sure.
Now, I want to add something too. Is you brought up Liz Chevelle, and we were just talking about some of the pro traders that have inspired us and whatnot. And I think from my perspective, since I'm not running a fund, and I trade my own account, but I'm not running a fund. But when I look back at my inspiration for putting those track records in, it wasn't to necessarily promote the advisors. It was to promote the validity of the trend following experience. And one little thing, and I'm not saying if you do this that you'll necessarily be the next Bill Dunn or David Harding or Liz Chevelle, but when you look at the performance track records of all the numbers that are out there, whether they're on the performance sites or in my books, just remember those are after fees.
Yeah, absolutely.
So when you're looking at those numbers you need to realize that, yes, for the investor that's investing with that particular trader, that is, that's the return. That's because the regulatory authorities, mandate that. They've got to have their fees removed before they can promote performance. So from an individual standpoint, what I'm saying is that when you look at some of these numbers, these great traders, just remember for their own retirement accounts, their percentage return is going to be much higher because they're not taking out fees for their own retirement accounts. And it's an interesting thing when you're trying to really try and ascertain how much greater trend following could do than perhaps a standard issue buy and hold mutual fund from Fidelity. It is fairly significant. And you hinted at this though too, and if you compound it, which is the free mathematical genius that's afforded all of us, it's really hard to make a comparison. And as you say, like, how do you get people to wrap their arms around all this? I guess we can just, keep having conversations about it. But I think it's really interesting to keep that in mind about when you're looking at all these numbers.
Yeah, absolutely. I mean, as I said, Liz Chevelle, I make it a point to tell people that this is, she's taken a 25% performance fee or 20% performance fee out of this data, yet we're still making 22%. It's huge. Phenomenal.
It's crazy. It's crazy. Well, listen, I don't want to keep you. I know you're on the other side of the planet. You got fun stuff to do today. Nick, what's the best website that folks can reach you at?
Well, we're at thechartist.com.au, or we're at nickradge.com, and the major trend following strategy that I use is called the growth portfolio. I think, a lot of what we do, we have a couple of US portfolios, but the major trend following portfolios we have are designed for Australian stocks. But in the new book, Unholy Grails, Mike, which was released a couple of weeks ago, there's a couple of strategies in there that are very, very powerful for the US market. And I think if your listeners in the US want some good, strong, robust trend following strategies for US equities, then a couple of the strategies out of the back of that book would go down pretty good. They work a treat. They're easy to understand. They're robust. The book is based on Australian stocks, but they're robust enough to work on any market in the world. So thechartist.com.au, I have to stress the .au on that. There is an American website that is not anything to do with us, chartist.com. We are thechartist.com.au or nickradge.com.
And let me interject here, folks. Nick is in Australia. If you are in the United States of America and you are thinking to yourself, this guy's in Australia, what does this have to do with me? You haven't been listening. It is a borderless world. Intellectual capital travels. Okay. It doesn't make a hill of beans difference where any of us are located. Okay. So tremendous insights can come from anywhere. And in Nick's case, they're coming from Australia. And if you for a second think that they're not related to you because Nick's in Australia, you might as well retire now because you're never going to get off the ground. That's my little verdict on it. So.
Yeah, well, I think you're right, Mike. We're very lucky here, and I used to work in London and Singapore. And yeah, look, the US financial markets, quite rightly so, are the center of the universe. But, our insights and our experiences, 26 years I've been doing this. One of our most successful portfolios is actually a US equity portfolio that we run, and it's quite popular out here in Australia. The Australian share market at the moment's in the doldrums and not doing very well, and it's a good diversifier to get involved in the US market. So, yeah, look, hey, we can do it. It's a stock's a stock. I don't care where it's listed. It doesn't really matter. It's just price action, right?
Hey, you were talking about the center of the universe. Hey, look, last time I checked, they weren't building new skyscrapers with football field parks on top of the skyscrapers like they are in Singapore and the US. If you can show me where they're building those in the US, I'd like to know. So this center of the universe thing, I have a feeling we all know the shift will come at some point in time. We just don't know when.
Yeah, that's right. That's right.
Well, listen, Nick, I'm going to let you go, but I appreciate you for being on today, and hopefully we can do some further conversations in the future. I think it was pretty fun.
All right, that's great. Thanks, Mike.
I appreciate it. I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.